Hey everyone, Jason here. I decided to make a short video about internal rates of return and how they relate to investing in real estate. Typically, they're used to analyze how businesses are performing. But as we all know, real estate is much like owning a business. You have incomes, you have expenses, you have clients who are your tenants, you have a product, which is the rental units. So they're really, your mathematical formulas look very similar when you're running a business as when you have an investment property. Internal rates of return are used to analyze the current performance of an investment or a business. A lot of people are unfamiliar with IRRs because they're rather complex. Usually you learn about cap rates, you learn about return on investment, but the IRR is more of an advanced formula, a more advanced way to analyze properties. And honestly, when you look at the mathematical formula here on the screen, there's a reason why people don't spend the time learning it. It is very complex. But what I want to do is break it down to the concept more so than the mathematical formula, and why that concept is very important to make sure that you're earning the highest return on your net worth, your equity, so that you can grow your portfolio, grow your net worth the best way possible. And sometimes that is done by assessing your current assets more so than buying new assets. So just a disclosure, I am completely going to butcher this formula. I'm not going to use it. I'm going to use simply the concept of IRRs and how to turn it into a tool to analyze your current properties. So this isn't going to be an exact calculation on how to do it. It's probably a loose definition of IRR, but it's the premise that you need to understand, and hopefully I can make it easy enough to follow along that you can use this in the future to make sure that your properties are performing well. So we'll start real quick with what an IRR isn't. It's not a cap rate. So a cap rate is your net operating income divided by the purchase price. So your net operating income, obviously you have your gross operating income, which is how much property or how much income a property generates in a year in the form of income. Then you deduct all of your expenses from that gross income. Once all your expenses are deducted, you have your net operating income. You divide that by the purchase price, and that gives you a cap rate. It's going to be a percentage. Quite often that's how commercial properties are listed and sold. You'll see properties offering 5 caps or 7 caps right in the MLS listing, or if it's off market, that will be a quick and easy way to analyze properties. If you're looking at buying 3 or 4 different types of properties, it's a good way to kind of get an overall understanding of which asset class will generate different cap rates, which locations generate different cap rates. But it doesn't really help you understand how the asset is going to perform based on your particular situation. And that's because it doesn't factor in for mortgages. So again, your net operating income does not factor in mortgage payments or interest on your mortgage. So everybody's going to buy properties a little bit differently. You might put 50% down, you might put 20% down, you might pay cash for a property, and that's going to affect your return on investment. But none of those things affect the cap rate. The cap rate is just how the property performs on its own, which again isn't really a good metric on how you should be looking at properties based on how you're going to be buying them. So again, doesn't calculate your ROI, the expected return on your investment. So an IRR also isn't a return on your investment calculation. So the return on investment, this is a little bit more in depth than the cap rate. It's a better way to analyze how properties are going to perform for you particularly. So this is your annual profit divided by your investment. So your profit, the annual profit, is going to be the cash flow. So and what you have left over at the end of the year after paying all of your expenses, as well as your interest on your mortgage and things like that. Your debt pay down, how much of that mortgage gets paid off, and how much the property appreciates. So these are all profit at the end of the year. Obviously, the debt pay down and the appreciation aren't a check that you take to the bank the same way that the cash flow is, but that's still profit that has helped you build equity, has helped you have more net worth. And when you go to file your taxes every year, it's that profit that you're essentially going to pay taxes on. So every year you should be analyzing the profit of all of your properties based on this formula that you're going to calculate all of the appreciation, debt pay down, and cash flow, and that is what you're going to essentially get taxed on. Once you have that profit number, you can divide it by your investment. Now, obviously, your investment isn't the purchase price of the property. So if you've bought a property for $500,000 and you put $100,000 down, your investment is not $500,000. Your investment is $100,000. So your return on investment is drastically affected by a mortgage. Because again, if you're putting 20% down, 80% of that property is leveraged, and yet you're still going to collect the profits generated by that other 80%, which is one of the biggest advantages of buying real estate is the debt. The mortgage is actually what creates the highest return on investment when you compare it to other asset classes. So with a return on investment, you'll typically see it climb year over year. This is because your rents will eventually climb over the years as you have tenant turnover and rents increase. You're going to see more cash flow in the form of increased rent. More of the debt is going to be paid down each year, just because of the fact that mortgages are typically interest heavy at the beginning of your amortization. So the first year of a 25-year mortgage, your payments are going to be very heavy on the interest, very light on the principal, whereas by the 20th year of your mortgage, a lot more of your monthly mortgage payments will be going to paying down the debt and less to the interest. So your debt pay down is faster as time goes by, and obviously appreciation as your property increases in value and continues to appreciate, it will be appreciating essentially on the new appreciated value, which is compound appreciation is essentially what it comes down to. Appreciation is a tricky one to calculate. We don't have a crystal ball for where the future is going to put appreciation. And even calculating how much your property has already appreciated can be very difficult because without selling your property, you can't get an exact dollar amount of what that property is worth. We all have a pretty good idea based on properties that have sold around ours, what ours might be worth. So we just have to kind of ballpark appreciation a lot of the time, but it's not necessarily a perfect number. And again, looking into the future, we can average it out over a 10 or 20 year window and say that we expect a 3% or a 5% appreciation over a long window, but that could come in the form of really high appreciation for 2 or 3 years and then very little or no appreciation for a number of years afterwards. It's averaged out over the term of you owning the property. So what an IRR actually is. So it's something you perform on current assets. You're not going to use an internal rate of return when you're looking at buying a new asset. It's a way to take a current property and see how it's performing based on the equity that's already in it. So it's a snapshot of your return on investment today based on your equity, not on your original investment. So again, if you take the $500,000 mythical property and you originally invested $100,000, but you've paid off $50,000 worth of mortgage, and that property's appreciated $100,000, you now have $250,000 of equity. So you're essentially going to calculate your return on investment today based on $250,000 of equity instead of the original $100,000 that you bought the property with. So as the years go by, you'll notice that the IRR continuously decreases. And it's very, very evident when you fast forward 10 years, 15 years, 20 years into the future. Your equity is going to be very substantial by that point in time. You'll have paid off a lot of the mortgage over a 10 to 20 year window. You can imagine the property might have doubled in value, and your equity goes from being $100,000 to $400,000 or $500,000. And that's going to cause your internal rate of return to decrease. And that comes back to the concept that you're going to calculate your IRR, basically taking your return on investment that year based on the equity that's in your house, which could be very substantial in the future. If your IRR has decreased, it's not necessarily a bad thing. It depends what your goal is when investing in real estate. A low IRR usually means that your property's actually done fairly well in the past. You've built a lot of equity in it. So it's usually a signal that you've done well. The issue remains with that equity that's in your property. Is there something better you can do with it than its current use? So that's when you need to assess if it's time to either refinance or possibly sell the property. So if you're focused on cash flow, you only want a paycheck monthly from your properties to be able to live off of, and you have a fairly substantial amount of capital or cash, then you might want to buy a property cash, or you have a property and the mortgage has been paid off or is almost paid off, and you're really enjoying that monthly cash flow, and that's what's your priority, then it's fine to leave a property with a low internal rate of return alone. If your goal investing in real estate is to build your net worth or build your equity as much as possible, as quickly as possible to save up for your retirement fund or whatever it is you're trying to work towards, a low internal rate of return might be suggesting that capital could be put into something else that's going to generate, help you grow your net worth or your equity faster. So if you calculate your IRR, you can use that then to see how your current property works in comparison to other things that are available in the market. Essentially, you're going to be looking at buying if you were to buy your own property today with the amount of equity that you have in that property, and then ask yourself, would you do that? If you have $400,000 equity in a $600,000 house and it's producing at that $400,000 investment price, it's producing a 10% return on investment, would you be happy with that investment? Or would you take that $400,000 and put it somewhere where it's generating a higher return on investment? That's the whole purpose of the IRR, is to make sure your money is being used to the best of its ability. So I made this fun little chart here. Hopefully it's pretty basic. This is, again, the hypothetical house of a $500,000 house with a $400,000 mortgage, and you used $100,000 of your money initially to buy that property. So these are just kind of rough, quick, easy math numbers. You can see in year one, we're generating $1,200 a year in cash flow. That's $100 a month. That's not a lot, but again, that's cash flow isn't about getting rich. It's about making sure that you can hold that property and that property is sustainable. In that first year, you see about a $10,000 debt pay down. So you've paid off some of that mortgage. The mortgage has gone from $400,000 down to $390,000. That's now $10,000 of equity you have in that property. And the property appreciates. It goes from $500,000 to $515,000. That's also $15,000 additional equity. Now, the debt pay down and the appreciation aren't checks that you can take to the bank at the end of the year, but that's still equity that if you were to sell that home, you'd be able to take out, or if you refinance the home, you'd essentially be able to take out. So combining those three things provides a $26,200 profit. So people new to investing see that, oh, this property only cash flows $100 a month. That's not very much. You can see that debt pay down and appreciation is where you make the real money in real estate. It has nothing to do with cash flow unless you're buying properties cash, in which case they can generate better cash flow. But it's really that leverage that enables you to have a more expensive asset that's appreciating and paying off that debt using income from the property. So you're essentially not responsible for the debt. Anyhow, $26,200 profit, $100,000 was your initial investment. That's a 26.2% return on your investment. That's not bad. That's pretty typical what we see in the real estate market, somewhere in the 20, 25, even up to 30% range, depending where you're investing and how much appreciation. Again, the appreciation is really a guess based on historic trends, based on an average of what you've seen in the past. It could be substantially higher than that, or it could be nothing, or it could be a depreciation. This is just an example of what you'd see on an average typical year. If you want to consider what an average year is in real estate, it's hard to even figure out what that is these days. So your initial equity in year one is the exact same as your investment. You invested $100,000. That's how much equity you have in it. Now, by the end of year one, so starting year two over on the right-hand side here, you see that the cash flow has gone up a little bit. So maybe we've increased rent in one of the units by $50 a month. That brings cash flow up to $1,800 for the year. We're going to see a little bit more debt pay down in the second year. Not a lot, but a little bit. And then appreciation. Hopefully, we're going to see a little bit of appreciation on the increased value from year one. That's going to bring your profit up to about $27,800. Again, your initial investment hasn't changed. It was still $100,000. That means in year two, you're seeing a 27.8% return on your investment. That's pretty good. And that's how you see real estate will continuously get better the longer you own it. It's the analogy of planting a fruit tree. The first few years, you might not get any fruit, but each year after that, the tree should be producing more and more and more as it grows bigger and stronger, as the rents increase, as you start paying down more debt, as you have more and more appreciation, your return on investment should be growing. However, your equity does change. So due to the debt pay down of the first year and the appreciation in the first year, you now essentially have $125,000 of equity in that property. So if you were to sell it and there was no cost of selling a property, you would walk away with $125,000, not just the initial $100,000 that you invested. So because you have $125,000 of equity, your internal rate of return is that profit divided by the equity, not the original investment. And that produces a lower number of 22.2%. So you can see how each year that goes by, you'll see a little bit more cash flow, a little bit more debt pay down, a little bit more appreciation. And that debt pay down and appreciation is equity buildup. And as that equity increases, your internal rate of return is going to start decreasing. Again, it's not a bad thing. It doesn't mean you're losing money. It just means you have a lot of equity in the property that might be utilized to do something else with. So some things to consider when you're thinking about IRRs and you've analyzed one of your properties is if the property can actually support an equity takeout. So say there's $100,000 of equity in the property that you can withdraw. You can take it out in the form of a home equity line of credit. You are maybe up to renew your mortgage and you just increase the mortgage by $100,000, but that property only cash flows $100 a month. Well, that additional $100,000 of debt might cost $400 a month to service. If you're only cash flowing $100 a month, that property is now going to be hemorrhaging $300 a month. And if anyone's familiar with my philosophy on real estate investing, it has to cash flow. If it's not at least revenue neutral or generating some form of cash flow, I don't think it's necessarily a good idea unless you are advanced enough to understand the long-term benefits of owning real estate and you're comfortable and in a financial situation to be able to support that property indefinitely. So if you've recently had a tenant turnover and you've seen an increase in rent, so rent has gone up $500 a month, and you have $100,000 of equity, you should be able to safely take that equity out of that home without going underwater, without that property failing to cash flow. So that's one thing important to understand. The property has to be able to support it. If you have a lot of equity and the property does not support an equity takeout, that's when you need to start maybe considering selling the property and reinvesting those funds into something else. If you are thinking of selling and buying something else, you also need to calculate all of the expenses of liquidating a property and buying a property transfer tax, real estate fees for selling, lawyer fees, things like that can add up to a pretty substantial amount of money. So if you've incurred $30,000 in cost by selling and buying a property, you essentially have to roll that $30,000 loss into the property you're buying. So that property really has to outperform the existing one that you're selling because you have that big cost of selling to offload, to essentially wipe out with the new increased profits of the new property. So factor that in. Another thing to factor in is appreciation. Quite often I see people selling in a market that has appreciated very well, which has meant they've built a lot of equity, and they see a market where there's more cash flow. They see a market that offers higher cash on cash or higher cap rates. And there's nothing necessarily wrong with that. But if you sell out of a very highly appreciating market and buy in a very cash flow market that's not expected to appreciate, you might earn more monthly income, but after a 10-year window, your return on investment might actually be lower from the higher cash flowing properties just because the property appreciation was better in the other area. So just a quick example of that, I own a few properties in Prince George and I own a few properties here on the island. And the Prince George properties cash flow better. They have higher cap rates. So essentially they look like a better investment. But I can tell you from the last couple of years of appreciation, the island, Vancouver Island, has done substantially better than Prince George. And I would much rather had my properties here on the island if I had to choose between Prince George and Vancouver Island. Even though Prince George cash flow is better, I've made a lot more money off of the appreciation on the island than I have the cash flow in Prince George. It's also dependent on your growth and your cash flow. So if your goal is to live off of cash flow, again, you're buying something cash heavy and putting a large percentage down or even buying cash, then you don't need to worry so much about your internal rate of return. If your focus is growing your net worth and equity as fast as possible, then your IRR is very important to calculate. Another thing to consider is the ability to redeploy all of your capital. So just because you take $100,000 out of a property in the form of a HELOC, or you sell a property and you have $250,000 to now invest, if you can't get that money back into some form of investment that's going to generate a good return on investment, you might not be better off, especially if you've increased your mortgage on a property. You've now incurred the cost of the interest on that borrowed money. And if it's just now sitting in the bank, not earning any money, it can actually be a detriment to you to be paying for the interest on that when the cash itself hasn't been redeployed to earn enough income to offset the interest. So that's a bit of a difficult thing to try to wrap your head around. But it's better in that scenario to have a home equity line of credit that you can draw funds out of when needed, instead of renegotiating your mortgage, having a lump sum of cash sitting in the bank until you can find an investment and you're paying interest on that. Versus a home equity line of credit, you don't have to pay any interest on it until you draw that money out. So that money is always available to you. As soon as an opportunity arises, you can pull that money out, deploy it into something that's generating a good amount of income, and that should offset the cost of borrowing the money from a home equity line of credit. Hopefully that was not too difficult to follow. It made sense in my head, at least. Refinancing can increase your return on investment. So if you invested, your original investment was $100,000, and 5 years goes by and you've paid off some of the mortgage and the property's increased in value, and you can now withdraw $100,000 of equity out of that property and still have a cash flow, your return on investment actually becomes infinite at that point in time, because you no longer have any money invested. You've been paid back your entire investment. So that's something that's very different than investing in stocks or bonds or anything like that. Is you can withdraw all of your capital, still hold 100% of the asset. So you still own an asset worth the same amount of money that's still going to appreciate the same way, that's still going to pay down the mortgage, still going to generate cash flow, and yet you've taken your investment out. Typically in the stock market, if you take your large initial deposit out and only leave your earnings left in the stocks or bonds, you're not going to see very good returns after that, because you've taken the bulk of the capital out. Real estate, that's really one of the strongest things about it, is being able to take the bulk of the capital out, or even all of the capital out, and then go redeploy that, buy another investment, and the original one will still continue performing, will still continue generating similar returns or even better returns than it did before. So I'm not going to get into the actual mathematical equation of calculating an IRR, which is, I'm sure everyone's glad to hear that. It is complicated, and I don't even know what the T over the backwards squiggly 3 even means. But anyhow, there are software programs on the internet you can use to calculate your IRR. I have a software program called Property Evaluator that I use to analyze properties. It is a Mac-based program, and it will give you your cap rates, your return on investment, and your IRR, as well as a number of other interesting, important financial equations. You put in your rental income, all your expenses, your mortgage details, and your projection of appreciation and things like that, and it will spit out all those numbers for you. But the quickest, simplest way to do it, and again, this isn't the proper mathematical formula, but calculate your return on investment, but instead of using the amount of the original investment, use how much capital you think is in the property, how much equity you actually have in that property. And again, you should have your profit known every year when you file taxes. You should be telling your accountant all of the income, all of the expenses, and that will give you your net profit. And then you're going to divide that net profit by the amount of equity that's in the property, and that's going to spit out your internal rate of return number. And again, as that number goes lower and lower and lower, you might want to realize that you now have a lot of equity in the home. It's nice to know that you have a lot of equity in the home, but it's also important to understand that that equity might not be doing anything for you. So it's known as debt equity. If you, this is a very common thing when it comes to people's primary residence. Quite often they might own $1 million home and be mortgage free because they've lived there for the last 25 years and they're very happy they've completely paid off their $1 million house. But they have $1 million of debt equity. That money is not earning them any money if it's their primary residence. One could argue that that property is appreciating in value, so it is earning a return in that aspect, but that's not a very valid argument because that property will continue to appreciate regardless whether or not you have a mortgage on it. So if you have a 50% mortgage or an 80% mortgage or a 20% mortgage or no mortgage at all, that property is still going to appreciate 5% next year or 10% next year or 2% next year. It really has nothing to do with the equity that's in that home. And if you can borrow that money at a very low interest rate, which is where mortgages are right now in the 2.5% range, and find an investment that can generate 5, 10, 25% return, that's putting that equity in your home into something that's going to be generating a return. So it's really no different if it's your primary residence or if it's an investment property. That equity is essentially dead if it's not doing anything for you. So the IRR is used to analyze how your investment is performing today based on the current equity. That's kind of the big takeaway. It's whether or not you would buy that property today based on how much equity you have in it. That answer is no. It might be time to refinance, might be time to sell. If your goal is to make sure you're maximizing the use of your money, putting your money to work for you to the best possible way, having a very low internal return on investment or internal rate of return is an indication that there's equity in there that could be put to better use. Using that IRR and then comparing the performance of that property, your current property, to what's available on the market. If you're finding that there's nothing out there that provides a better return on investment, then you're best just to leave it alone. But if you're finding that typically in this market, you can find a 20 or 20% return on your investment and your current property is only at a 6% internal rate of return, that's a lot of debt equity that could be leveraged into building equity and building your portfolio. So hopefully that wasn't too over the top or too complicated. It's a difficult concept to wrap your head around. I've tried to simplify it the best possible here. Only recently have I really started understanding internal rates of return and how important it is to know these numbers. I came to the conclusion when I was doing my own taxes, or not doing preparing my taxes for my accountant, and I was looking at the performance of my properties, and I started realizing that, you know, they were all performing about the same, and yet some of them I had a lot more equity in them than other ones. And I started asking myself, well, is that the best use of that money? I could essentially sell one of my properties and buy 2 more with the amount of equity that's in there. Does that make sense? So at least once a year, I think it's a good idea, kind of around tax time, to go through your portfolio, make sure your properties are performing at the best they possibly can, make sure you're keeping expenses low, make sure you're keeping incomes the best you can, and see if there's a dead horse that you need to cut loose. If sometimes there's just obvious properties in the portfolio that just aren't performing, and if you can't find a way to make them perform better, then you might be better off cutting it loose and finding something else. So hopefully there was value in this video, and yeah, stay tuned for the next one.